Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending October 6th, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme, we kicked off October with a bang, but that's normally what we can expect in the month of October. Let's take a look at where we are this past week and what looks like we can expect as we move through the month of October. You can see it's kind of a mixed bag in the U.S. index. Russell down pretty good. It's down year to date. Dow is down also, but it just barely managed to close in the green for the year. S&P and NASDAQ all up for the week, but not that much. NASDAQ leading the way. You can see the forward PE ratio of the S&P has come down a little bit. I still think it's a bit high given where the current interest rates are at 19.17. Dividend yield is a lot less than the 10-year Treasury by the tune of 314 basis points. That's almost 3.14%. So that's going to continue to challenge equity markets for easy Treasury yield and money flow. Earnings yield for the S&P is at 5.06%, given the current forecasted earnings over the futures market right now, 5.06. You can see it's about 186 basis points real yield, meaning over the current inflation rate. Current VIX fairly flat for the week. You can see the prior week it closed at 17.52. This week 17.45. So just about flat for the week. Best performer this week, technology, even given the high run up in 10-year rates. Tech is up. The worst is energy for the week. Look at the year to date. You could see utilities is really getting crushed. All right. Down over 30% for the year. Communication services up almost 27% for the year. Okay. So it was a very interesting week, folks. We had ADP report come out Wednesday, which is a little bit net positive for the markets because it showed a really bad potential jobs number. And then Friday, the initial reaction to the 336,000 non-farm jobs payroll and non-farm jobs rather in September was for the markets to sell off 30 or 40 points in the S&P. And then when they started digging into the report, they saw that, well, wage growth is neutral to coming down just a little bit. So the markets reversed and moved up into close on Friday. Otherwise, we would have had a down week in most of the indexes. Okay. We did get, the 12-month average for non-farm jobs is about 266,000. So we're having a lot of folks back, but a lot of these folks are not full-time, they're part-time. And, the feds want to see the jobless rate, unemployment rate get over 4%. And to get there from where we are now, that jobless number or the non-farm jobs payrolls need to come in around 105, 110,000 a month. We're not even close to that. So we've got a fairly strong, robust economy underneath the ocean here. But again, a lot of that is part-time work. And we're seeing here that the 10-year U.S. Treasury note had a high, 16-year high this past week of 4.89%. You can see it closed at 4.78%. Okay, but still very high. But either way, we've got the November federal meeting, which is going to the Feds, and Boom Powell speaks in his press conference. But this is going to be the first day of November. They actually meet the last day of October on Tuesday, and then the first day of November, Wednesday. That's just how their calendar session falls in line. We're going to get the rate hike or not November 1st. Now, the markets are forecasting a 73.4% chance of no rate hike November 1st. I would probably agree with that. Although it's a little bit higher, maybe 55% chance of no rate hike in December. We'll see, because next week we get some really big key numbers on inflation. So we'll see how that shakes itself out. Okay. Now keep in mind, you can see the current 10-year yields at 4.78. Just in March of this year, that 10-year is at 3.23. So we've moved up. That rate of change in the 10-year creates a lot of issues for the equity market. Moving up higher steadily and slower is okay, but the markets tend to get batshit crazy when these yields move that fast, that quick, right? So that's a little bit about what I see there, and then of course you can see here if we go over to the European markets. Let's just get the European markets in here. You can see over the European markets here, everybody was in the red, right? Euro stocks, FTSE, CAC 40, DAX, all in the red. Year to date, they're all in the green. The FTSE's barely holding in. Um, Eurozone activity, we got their private sector data. The composite PMI, which is put together by S&P Global, it combines both manufacturing and services, came in at 47.2 in September. That's the fourth consecutive monthly contraction. Anything below 50 is a contraction, right? So we're seeing a real strong slowdown across in Europe. Meanwhile, German exports, which is kind of the bus driver across the 19 countries that make up the ECB, they're the largest economy there in Europe or in the ECB. Their exports fell 1.2% in August, right? Um, that was a lot more than they were expecting. And it also fell 1.9% in July. Now, a lot of the German exports go to China, and China's not buying right now. China's got their own problems. But that just, all that does is put downward pressure on the European equity markets. Now, if we come over and we look at the Asian markets, let's look at Japan first. You can see Japan had an ugly week, still strong year to date. It's the one that's coming in closest to the U.S. Nasdaq. So the Nikkei is up 18.92% year to date. But equities came under pressure there because of the huge bond yield surges that we're seeing here. And in Japan, we're seeing their economic data show that their real wages and consumer spending continue to fall in August, right? And also weighing on consumer sentiment there is a real weak yen. It's hovering around 149 to the dollar. It's around that level where the Bank of Japan starts to take action. Right. And the 10-year Japanese government bond is up to 80 basis points. Even though the Bank of Japan's trying to bring it down a little bit, they're not able to do it. All right. It was at 76 basis points previous week. We are seeing deterioration in Japan's manufacturing. Their PMI came in at 48.5 from 49.6 in the previous month. So they're in contraction territory as well. China, meanwhile, again, they're closed. I wish we had holidays like them. Their financial markets have been closed all week long. They call it their Mid-Autumn Festival and National Day holiday. They don't open again until Monday, this coming Monday. And I'd hate to see the opening gap after being shut down for a week. But we're seeing their factory activity is moving from below 50 to above 50 slightly. So that moves into expansion territory, but just barely. They're sitting at 50.2 in September. In August, they're at 49.7. So they're kind of, let's just call it flat. And their non-manufacturing is at 51.7. So they're pretty much flat for the year. Consumers aren't spending. Real estate markets are showing signs of stabilization, but just not great. Okay. So that's a little bit of what's going on over there. So net, all across the globe, we're seeing contraction. We're seeing high interest rates. Inflation is coming down. So Q4, in my mind, especially here in the U.S., is really going to be bigly determined. Bigly will be determined mostly by Q3 earnings and forward projections of these earnings. Now, I will remind you guys that the markets and companies have had a lot of revisions to the upside. So that raises the bar for earnings for Q3. So the bar is higher than it would have normally been with these revised upward numbers for earnings. And we get earnings kicking off this next week. We're going to see some of the banks, which to me are the ones that really going to kind of market on Friday, 10/13. We're going to get Citi, JP Morgan, and Wells Fargo. And then we really start to get into the thick of earnings the following week, right? We got a couple coming out this week, Pepsi and Walgreens, but the ones that really are going to affect the markets once we start with the big banks on this Friday and then next week. So if earnings come in at or above expectations, it should set the stage for a nice little lift in the markets, especially if we get inflation showing that it's pulling back, steady to pulling back this next Wednesday. We're going to get the CPI data Wednesday and Thursday. If that's not the case, then we can expect further downside. All right. So just understand that's kind of where we're sitting right now. The other thing that's creating some agita in the U.S. markets, U.S. deficits are projected to come in at about 6.5% of the U.S. GDP. Now that's the deficits, almost 2 trillion, right? And the only time that we've seen the deficits come in this high of a percent of GDP is either during recessions or wars. So the muckety mucks that are in Congress and the Senate, they've got a tough row to hoe to get that get these deficits down. We're going to see how that all works itself out. So what I want to do is I'm going to shift the screen over and I'm going to take you to an SPX chart here. Just bear with me 1 second. Now this SPX chart, it's going to take about 10 seconds, 10, 15 seconds to come up on your screen. So we're not looking at the E-mini future S&P. We'll look at the SPX first, the cash index, and then I'll show you others later. But you can see here from this low that we made over here on 10/14 of last year to where we are right now, we're up about 23.40%. Okay. So almost a year, because this low was made on the 13th of October. Right now, we're looking at the 6th of October when the market's closed. So almost 1 year, the SPX is up 23.4% in this fiscal year period. So that's a lot, folks. A little bit of a pullback here, August, September, possibly into October, should and could be expected. Now, I had our members all prep for this back in June, July timeframe. There should not be any surprises for our members. In fact, many of them are making money on some of these moves lower. But if you look at this, I also put in here fib retracements, and you can see there's a fib retracement sitting at 43.43, right? 44.16, slightly higher than this, is the 50 EMA. And you can see here there was these yellow bars which represent a general track area of support down below, of which the 38.2% fib node is like right in the middle of it. And you could see this gap right over here on the far left-hand side of the screen, which forms the northern boundary of the support area. And you could see as I move this trend line up, it's hit nicely and we held here and then we moved up. So we can expect in the SPX overhead resistance around 43.43. Let's call it 43.50 area. Okay. One other thing I want to show you, which probably you've picked up. If not, I'm going to just kind of blow it up for you and show you here a little bit better. You can see here clearly a head and shoulders pattern. All right. That being the left shoulder, this being the head, this being the right shoulder of a pattern. And then this line here, we'll call it the, I don't need exact precision, but we'll call that the neckline at 43.43, right? Now, and the measuring objective is when you break the neckline, which we've done here, the odds favor a retest. We attempted one there. We'll probably do another one right there. And if that retest fails, then that just go on and solidifies that it's probably going to roll back over. And the measuring objective of this is always the head to the neckline. So if I were to just kind of do a quick and dirty, it won't be exact, but it'll be close. And I just do from the head to the neckline right there. You can see about 5.62 points. So if I move it down and show you what the potential can be, that takes us down to about 40.80, just slightly above the 50% fib node. And again, none of this would surprise me if we got down there. All right, none of it. And you need to prepare your portfolio for that should that happen. And if I just kind of move it up to give you an idea what that pullback would look like, right? Let me just get this on here centered on my screen a little bit. Let's get it over here. Oh, I don't need this. I'll close that down. And if I move it up to near the peak, it would represent roughly a little bit over a 10%, call it 11% correction if we get the full measuring objective. Should it fail at this level right here, that'd give us about 11% pullback. Correction being 10%, right? That's an official correction. Again, I will remind you that we normally have one correction every year. And it wasn't up until about late summer in August when we finally started seeing the SPX and the S&P give us more than 1% down moves. Up until that point, I think we had like over 100 plus days without even having a 1% down move. And a 1.5% was like 190 days. And then we got a few in August. So again, with that big run up here of 23.4% off these lows back over here, right? Then none of this should come as a surprise for any of you guys, or at least for our members for sure. So let me just get that all off the screen here and get that back. And I just wanted to show you guys just a little bit about where we're sitting right now and where that overhead resistance resides. Now I'm going to switch over and let's just take a look at the futures market because I've got a couple more things on that screen. Let me just shift this over real quick for you guys. It'll take about 10 seconds to come up on your screen. You're going to see the yellow and red lines, yellow being the 200 EMA, the red line being the 50 EMA. You can see we hit our target perfectly right here, slightly below the 200 EMA. All right. And you can see it's holding. Intraday, we've moved below the 200 EMA just one day. That was on October 3rd, the first day of October. And then we've kind of moved up here. And we're sitting between these railroad tracks right here, which is overhead resistance. You can see the 50 EMA, which is going to serve as overhead resistance at 44.16 on these futures contracts. And then here's a fib node here, 41.75, let's call it. So I do believe the odds favor a little bit of a bounce and then a rollback over again. You can see the MACD, there is no divergence here. That would suggest that any move higher is probably going to be sold off, right? So we got to watch this very closely. And then, of course, if we look at the Russell, you can see the Russell is in the red for the year, right? The red, anything below that, the light blue line is below the closing price of 22. You can see we've come down there. We did not hit our low for the year, which was made in March, but came very close. And we'll probably find resistance at that 1777 area on the Russell futures, okay? And then, of course, if we look at the Dow, it's barely in the green. We were in the red for a little bit. You can see right here, we were in the red and then we moved up. We're below both the 50 and the 200 EMA. So that's going to be the overhead resistance in the Dow. My original target was right here, then I moved it over to the 200 and we just kept going lower and lower. You can see that MACD suggests any move higher is going to roll over. Just understand the big delta between the Russell being down around 2 or 3% and NASDAQ being up about 27, 28%, 28, I think. That's a huge delta between the two. And those two are going to get back in alignment again. As I told our members, doing a pair trade where we go long the rut and short NASDAQ makes a lot of sense for me. Over time, these two will come closer together. Okay. Short term, anything can happen. But right now, we got a big determining factor. We got earnings coming out, and we got inflation next week. So that's going to be a big short-term guide for us leading into the Fed Boom Boom Powell press conference on November 1st. Okay. If we come down here and we look at volatility, if we look at the VIX, you can see the choppiness in the VIX. We moved into the 20 intraday, but we couldn't hold it. But again, we were challenging these levels right here, okay, which I was telling our members that's probably what we can expect. It's not going to be a big vol event like we had back over here in March. But should we roll over and take these lows out this past week, we will see vol come back up into the mid-20s, okay, maybe intraday higher. But I think right now the markets are due for a little bit of a bounce because we're oversold, right? And of course, if we look at 10-year treasuries, we go to the, where is it? Right over here, we go right here. We've gone down to my support area. I mean, my forecast was 107. right? We closed damn near the lows for 2023, right? Um, I think the low right now, 108.29 versus 109. So I think the low here is right there. Is made this. I think it was right there. I got to get it on here. Oh, come on. There we go. 108.29. So you can see that we're real close to my target, both time and price, right? And there is no divergence in this that suggests any rally is going to be beat right back down again. So we're lower in 23 than we were in 2022. Okay. So we're not having a good finish to the year for bondholders. Okay. But I think bonds are going to be a screaming buy shortly. Not right now, but they will be. And then, of course, if we look at the 10-year interest rate, you can see here it's moving near my target. Right here, my target was around 5%. For the 10-year, we're sitting right up near October highs that were made. The highs were made right on October 2nd, around 4.8. I just don't think, um, um, yeah, this was even higher. So we made a new high right here, right? 4.84. Let me just see here if I get it right on there. Yeah, 4.887, right near my target of 5%, right? No divergence in the MACD that suggests any move lower is going to be higher. So, folks, net on these charts, both equities and the bond market and interest rates, I think rates still have a little bit higher to go. And equities, the odds favor, if we do get a bounce, expect a rollover. That's where the odds are placed. Now, all that can change with a few words from Boom Boom Powell on November 1st or very strong earnings. But outside of that, that's what the price action seems to be expecting at this moment in time. And of course, if we look at the US dollar, um, it's starting to steady out just a little bit here. We hit highs back on October 3rd. But again, with the dollar, any move lower, you could see that MACD is nothing but a consolidation pattern. You can see the 50 crossing the 200, which tends to serve as a magnet to come back and test. Any move lower is probably going to be bought in the US dollar at this point in time. And members, we'll look at the yen and we'll go into detail on where I think we got some good plays in the yen and how we can do it. Okay. In fact, the trades that I've been recommended have just been money makers for the past 4 months in the yen. And if we look at gold, you can see gold had a strong day on Friday, but we're around my target level, right? This was my target for gold. My central point for gold was around 1850, right? And right now we're at 1847. So we're right around that level. You can see it just watershedding off when interest rates went ballooning, because who wants to hold gold when rates are so high? They're going to stay higher for longer, the MACD. Any rise in gold more than likely is going to be sold off. So just anticipate that for those of you out there that like to play gold. Silver is the same way. It's hit my target, and any rise in silver is going to probably get into resistance right here and roll back over, as suggested by the MACD. Copper, because we're seeing China start to hit a consolidation period, and you could see copper's testing the lows that it made back over here in May. Maybe taking some long positions or bull put spreads in copper may make some sense. Now, if we do fall into a recession, all bets are off. My original forecast for copper would come way down here. So we may not be done with downside action just yet in copper. Of course, with energy, it had a huge couple of down days. I mean, you could look at that. This is where oil came up and hit my target and then just fell off the table, right? Now, our strategy in trading these would have worked out. We would still be able to make money in these with our strategy, even entering while oil was up here. Okay. You can see here this MACD suggests any pullback is going to be bought, and we may get some consolidation around the 200 EMA. Notice we're just barely in the green year to date for oil. There was the closing price of 2022 around 80.51 per barrel on the WTI. So let's see how this thing shakes itself out. What can I say about nat gas, guys? It's just been a moneymaker all year long. I mean, look at this. We've been running up here, bull put spreads the whole way, going all the way back to April, May timeframe. Initially, it was flies, but then converting over to bull put spreads, just a moneymaker. Now, I would expect this to pull back into the regression channel. It did get ahead of itself just a little bit. I mean, we moved down from the bottom to up and over the regression channel. You can see last time we moved over it like that. It doesn't stay there for long, maybe a couple of days, and it'll come back in the regression channel. I'd let it pull back if you're not in bull put spreads. I mean, that's just it's a freebie for you folks out there watching this that aren't members. But that's just a really easy trade to pull. Okay. So, folks, that's a little bit about where we're sitting right now in these markets. We got an interesting week coming up. We got inflation midweek. That's going to give us a good tone. And then we get Citi, JP Morgan, and Wells earnings before markets open Friday, the end of the week. So it should be a real interesting week. Earnings are going to give us a good indication on just where equity markets want to fly as we go through and leading up to Boom Boom Powell's press conference on November 1st. Have a great weekend, everybody. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao.